So, right now, if you've got any money in the stock market at all, well, you probably feel like Warren Buffett. Your portfolio is up, the numbers are green. Every time you open the app, it's a little bit higher than last time, and honestly, it feels great. Everyone on Twitter is posting their screenshots. Every finance guy on YouTube is doing victory laps. The S&P 500 keeps printing new all-time highs, and there's this collective vibe that, we've all kind of figured it out. We're investors now. We're patient. We're long-term thinkers. We're basically Buffett in cargo shorts. But I want to stop you for a second. Because if you're in your 20s, and I mean really in your 20s, not pretending, this market roaring isn't actually as good for you as you think it is. In fact, I'd argue it's working against you. And nobody's saying this out loud because, well, it kills the vibe. So let me explain what's actually happening and why feeling like Warren Buffett right now might be the most expensive feeling you've ever had. Here's the thing nobody wants to admit. There are basically two types of people in a bull market. There are the people who already have a lot of money in the market. And yeah, for them, this is amazing. Their existing positions are appreciating. Their net worth on paper is climbing. They're getting wealthier while doing literally nothing. That's the dream, right? And then there's the second group, the people who are still trying to build a position, people who are putting in $500 a month, $1,000 a month, whatever they can scrape together after rent and groceries. And for that group, which is most of us in our 20s, a roaring bull market is actually a really bad deal. And here's the core logic, the thing I really want you to understand. When you're young, you are a net buyer of shares. You're going to be buying every single month for the next 10, 20, 30 years. You have way more buying ahead of you than behind you. So what do you actually want as a net buyer? You want low prices. You want things on sale. You want the market to be cheap, boring, hated, going nowhere, so you can scoop up as many shares as humanly possible while everyone else is scared. Think about literally anything else you buy. If you love coffee and you buy it every week, do you celebrate when the price of coffee triples? No. You're a buyer. You want it cheap. The only people who celebrate higher coffee prices are the people who already own a warehouse full of it. The sellers, the people sitting on a stockpile. Same exact thing with stocks. High prices only benefit the people who already accumulated their position and are getting ready to sell. But you're not selling for decades. You're trying to accumulate, so expensive shares are the last thing you want. You want to gather up as much ownership as possible at the lowest price possible while you're young and still buying. Every time the market goes up, each share you buy gives you less ownership for your money. Your $100 buys a smaller and smaller slice. Your ticket out of the 9 to 5 just got more expensive. And I want to make this real for you because I've actually lived both sides of this. Back in the COVID crash, March 2020, the whole world was panicking. Everyone was selling, everyone was terrified. I did the opposite. I bought aggressively. While everything was on fire and red, and everyone was telling me I was crazy. And that single decision, it netted me a 50% gain as the market recovered. Not because I was a genius, just because I bought when things were cheap and everyone else was running away. And more recently, when the tariff news hit and the market took that sharp dip, same playbook. Everyone freaking out about headlines, red across the board, doom everywhere. I bought again. And since then, my portfolio is up around 30% from those buys. Both times, my biggest gains came from buying when prices were low, not when they were high, not when everyone felt like Warren Buffett. When everyone felt like the world was ending. That's the whole lesson. The crashes weren't the danger, the crashes were the opportunity. The danger is what feels safe, buying when everything's expensive and everyone's celebrating. And this is where the cope kicks in. Because people will tell you, oh, but the market always goes up over time, so it doesn't matter when you buy. And sure, over a 40-year window, you'll probably be fine. But there's a massive difference between fine and free, between retiring at 65 with just enough and actually escaping the system in your 30s. The buy-in price matters. It matters a lot when you're the one climbing in, not the one already sitting at the top of the ladder. So, what do you actually do about it? Well, here's where it gets interesting. Because if buying assets is now expensive, the math forces you in a different direction. It forces you to focus on the other side of the equation, not how much you can buy with what you have, but how much you can earn in the first place. See, when you're in your 20s, your single biggest lever is not your portfolio return. It's not whether you picked the perfect index fund. It's your income. A 30-year-old with a $50,000 portfolio earning 8% makes $4,000 a year from the market. But a 30-year-old who learned a real skill and built a service business on the side, they can add 5, 10, 20 grand a month to their income. One of those compounds slowly. The other one changes your life this year. The bull market is making accumulation expensive. But the income side is 10 or 10 di down chi That's still wide open. That's still a game where being young, hungry, and willing to learn beats being rich and entrenched. So flip the script. Stop obsessing over what your portfolio did this week. Stop refreshing the app. Stop comparing yourself to people who got in 5 years before you. You can't change the entry price. You can only change how much money you have to throw at it and how ready you are to pounce when the next crash finally comes. Because the people who actually escape the 9 to 5 aren't the ones with the cleverest portfolio. They're the ones with the cleverest income and the discipline to buy when everyone else is scared. And here's the irony. The same bull market that makes you feel rich is the exact reason you need to take income seriously. The gap between people who own assets and people who don't is widening every single day this market climbs. The only way to cross it from your side is to dramatically increase how much you can shovel in and to have dry powder ready when prices finally drop. You can't outinvest a head start. You can only out-earn it and outweight it. So here's what I want you to take from this. Yes, your portfolio looks great. Enjoy it. But don't let that feeling fool you into thinking you've made it. What you're really looking at is your ticket out getting more expensive in real time. The answer isn't to panic or to sell. It's to stop treating the market like the game and start treating your income like the game. The market is where you store the winnings. Your income is where you actually win. So if you're ready to stop feeling like Warren Buffett and start actually building like one by focusing on income, on skills, on being ready to buy when everyone else runs, hit subscribe. Because that's what this channel is about. No hype, just the real math of getting out. See you in the next one.